Okay, for this week we're going to have a look at Deutsche Post, the massive delivery company and postal company that's originating from obviously Germany. But at this point, they're definitely not just operating in Germany, even though they have cornered the market there pretty well. They're also very much expanding to every single part of the world that you can basically imagine. They're over in America, they're over in the Pacific parts of Asia. They're in Europe, of course. They are in Germany predominantly, um, and well, that covers most of the places where they operate. But they are very big, and definitely the biggest postal service in Europe, about 10 times bigger than the Royal Mail Service from the United Kingdom, and about 50 times bigger than the postal service in the Netherlands, and about 100 times bigger than the postal service in Belgium, which of course are small companies, but still, it kind of gives an idea of just how big this postal company really is. It's on about the same level as Federal Express's FedEx from the United States. Okay, so when we look at their revenue here, we can see in 2012 they had 55 billion in revenue, all the way down to 81 billion in 2021, which was a massive growth because of the COVID pandemic, because everyone was getting stimulus checks, everyone has been told to stay at home because of social distancing, so people couldn't really go to stores anymore, so of course they had to order all the all the gadgets and all their clothing and everything. They have to order it online, and of course if you order it online, it's going to have to be delivered to you, and that is the business that Deutsche Post is in. So of course they made massive tailwinds from the COVID pandemic. So we see a massive growth here in 2021. Overall, the revenue has grown 4.4% over the last 10 years, which is mostly influenced by this COVID blip. I think if we take this out and actually try to normalize it and more similar to the other previous years, we can actually see that they've been growing about 2% a year, which is like in line with inflation. It's not as impressive a revenue growth as it could be for many other companies. But of course, like, it's a postal company, and the amount of mail being delivered is reducing, although the amount of packages being delivered is increasing. So that's like their growth position and the thing that they're aiming at here for the future. Looking at EBITDA, might notice here that the A is missing because it's also missing in most of their financial reports. That's simply because amortization is a very big part of this company, and that's why I'm actually willing to look at EBITDA, so earnings before interest, taxes, and depreciation, and leave out the amortization. Actually have that included into this number, because amortization is basically the paying of an asset over many years of time. So whenever they buy a new fleet of electric trucks, for example, they expense that over 10 years, and that is the expense that's included in the earnings, because I think it's an important and necessary piece for their business, because they simply can't operate without it, and that's why I'm actually okay with including that into the earnings number. Looking at the earnings, though, we can actually see it tells quite a different story than the revenue is, because their earnings have been growing by 13% year over year. Even though the revenue is relatively stable, they are seeing increased profit margins, which is always very much what we like to see. They're becoming more efficient. They're becoming more mature in operating their business. Now, part of this is, of course, because they are operating more sustainable with electric vehicles as opposed to using oil, but it's also just because they're more efficient with their routes, and because they've got more customers and um, more efficient cars. So 13% year over year, mostly influenced also again by the COVID spike. And if you just quickly trying to normalize this number as well, just to give a number without the COVID stimulus years, we can see on average it's growing about 7%, which is still actually really quite good for a postal company. Looking at that debt level, we can see here that they started at 2 billion of debt in 2012, which is basically nothing if you just realize that, like, even less than 1 year of earnings is going to cover that expense. Now, the thing is, though, what you might notice here in 2017 and 2018, there's a big spike in debt level, and there's no spike in cash on hand, and there's no big increase in revenue or earnings that we can see. So you might be wondering, okay, where's that debt level coming from? Well, this has mostly to do, and I think I wrote it here. I wrote it over here. It's mostly like an accounting thing that happened in 2018, where companies were required to add the lease liabilities on their debt sheet if they extend more than 12 months. So as you can might imagine, Deutsche Post has many sorting centers or storage centers or hosting places for their cars or their airplanes, and they lease that uh, for several years' time. Now, previously, a contract like that, because it's set in stone, right? So, like, it's a payment that you're going to have to make years down the line. It's you can't really come out from under that. And they actually passed a law here in Europe that they actually need to post that as a debt expense for the future. So the big increase here in debt that you see is mostly because they have about 10 billion worth of lease payments to make in the coming years. So it's not really because they were borrowing more money, it's just because of an accounting change. Um, which is of course going to skew the numbers here a little bit, which is unfortunate for them because their debt has been really, really low, if not for the lease liabilities. So looking at the excess cash here, we can see that they have quite some cash on hand at all times, which I think is always important for a business like this, where you need to replace many parts of your business. You need to buy new fleets of cars, new mail carriers, pension plans. Always nice to have some cash on hand there. Market cap, I realized now I forgot a zero here. There we go. Market cap has been steadily growing by 12.9%, which is slightly above the market average, from 2.4 billion all the way to 73. Sorry, from 24 billion all the way to 73. Now looking at enterprise value, again, enterprise value is the market cap to which you add the debt and subtract the cash. Is the entire value of the business in the terms of a big competitor that maybe wants to buy Deutsche Post. Now I'm not sure which big competitor that will be. I guess UPS, I think, is like the biggest mail carrier in the world. So maybe one day they think about buying Deutsche Post, and if they do, they of course have to buy all the shares from the market, which is the market cap that we see here. But they also have to incur the debts that Deutsche Post has, and also they of course get the cash. Although most of the time, to be fair, the cash gets handed out to shareholders. But that's really dependent on the agreement that they have. So looking at that EV/EBITDA ratio, we can see here that they've actually been valued relatively high comparatively. And I think this is because they have actually quite some historical growth, and probably because many people see a very big future in the parcel business, because as more companies start to put up web shops as opposed to physical boutiques and physical stores, of course the amount of parcels which are going to be delivered are going to increase. So I think that's the growth story that people here are aiming for, and this is one of the reasons why the EV/EBITDA ratio is actually relatively high, sorry, compared to many other European companies. On average, it's been about 12.1 times. Looking at the net debt to EBITDA ratio, we always like to see a number below the 3 times. So what we actually see here is in 2018, because of the accounting change, it exceeded the 3.9 times. But it's important to realize that none of these debts that you see on this balance sheet from 2018 onwards is short-term debt. This is all including long-term debt. The 10 billion in debt that was added here is all long-term debt. So it's not in any way a risk of bankruptcy. So that's actually why I think this actually gets to pass, because it's not risking their business as a whole. And we can also see actually they paid down, well, not really paid down, to be fair. I think it's mostly that the earnings just grew a lot more to actually try and cover this debt, which is also works. You know, if your debt ratios is too high, either pay down the debt or make sure that your earnings are increasing a lot. That doesn't really matter, which is yeah, fair play to them, I suppose. Looking at their cash flow here, now what we see actually in 2012, which is again a bit of an annoying thing here when we look at the overall data, because in 2012 they had to incur quite some costs here, because they had to brush up their pension plans, which was costing them a lot of money. If not for that, though, their cash flow from operation would have been around 3,000. So I just want to say that if you look at the annual report, you do see this number of 219 reported here because of the pensions. But I'm actually going to normalize this here to give us a better estimate of what their cash flow from operation has been doing. So looking at that cash flow from operation, we can see that it's been growing from about 3 billion all the way to 10 billion in 10 years time, which is an annual increase of 14% year over year, which is really quite impressive. And what we see that capex, or the capital expenditure, this is all the costs that Deutsche Post has to make, and Deutsche Post has to make quite some costs. Okay, these are all the new cars that have to be bought. This is all the oil changes, all the fuels, all the storage facility upgrades, everything that they need to actually keep operating their business. And it's also been increasing as they have been expanding into different areas of the world. Of course, they also require additional funds to finance that. So what we see here is actually that those costs have been growing at 10%. Now, as I always say, we always want capex to increase at a lower pace than cash flow from operation, because that means that there are increasing margins between the two and their profits are increasing, which is very much the case here for Deutsche Post as well. So I'm also actually going to normalize this here just to get a better estimate uh, of what the cash flow has been doing. So if we look here at cash flow, they started off with 1,600 and they went all the way to 4,092 in 2021, which is very much the odd one out if you look at this entire number. You know, these are all very similar numbers, and then you get 2021. COVID, goodness gracious, it was an amazing time for postal delivery companies. But do take that with a grain of salt. I always want to say that this is like the best case scenario. Everyone and their grandmother are ordering things online and have things delivered. This was the best that earnings was ever going to be in 2021, and it's going to come down. Trust me, it's going to come down. So please do not assume that this growth will continue. But that being said, overall, the free cash flow has been growing at 11%. Their shares are as flat as they can be. They started off with 1,230 million shares, and they still have 1,230 million shares. It deviates a little bit every now and again. There's some stock-based compensation going out, but then again, they quickly buy those shares back to compensate, which is, I mean, good for them for doing that and not diluting the shareholders. Free cash flow per share therefore grows exactly in line with free cash flow because the shares are the same. So, yeah, share price increased by 15% year over year on average, which excludes dividends. So again, on average, this means that Deutsche Post has been outperforming the stock market over the last 10 years. Good for them. Free cash flow yield on average has been 3.5%. For the last 2 years, it's been quite a bit above that, but that's because their free cash flow has been actually quite insane comparatively. On average, though, it's been 3.5. Okay, so let's try to project this company into the future. Let's see where we think that Deutsche Post is going to be headed 10 years from now. Now, the nice thing with Deutsche Post is that their earnings and revenue does not fluctuate as much as, for example, Basic Semiconductors, which we looked at last week. The revenue has been steadily growing, and their earnings have also been relatively steadily growing, which makes it easier for us to actually predict this company into the future. And it's something that I prefer over the wild speculation of growth stocks, even though there's certainly like a growth aspect to Deutsche Post as well, and it's not as clear cut as, for example, the grocery chain of Ahold Delhaize or of Veolia Waste Management, which are a lot more stable and easy to project. This is a bit more tricky, but we're going to give it a try anyway. So if I looked at their half annual numbers and quarterly numbers for 2022, what I realized is that their earnings, like I mentioned, is not going to be as extraordinarily high as it was during the COVID peak. But that being said, their earnings also aren't really that low either. They're actually, I think, like in the mid 3,000 million euros of free cash flow range. So it's not a very big decrease, but I'm just going to go ahead and say that they're going to decrease on average for 5% for this year, which I think is being very nice to them. I don't think that's conservative at all. I think it's doing them a favor in their valuation. But afterwards, I'm going to say that even though historically they've been growing at 13%, I'm going to say they grow at 10% for the 4 years after that, and I'm going to give them a 7% increase after that, because I think there's only so much you can really expand to as Deutsche Post. Now they've been expanding a lot and expanding to many different countries, but there are quite some competitors out there when it comes to the postal service. Most countries have their own postal service, which compete with Deutsche Post and kind of presses their margin. So I think their growth story is a bit limited in the future. So I'm going to give them 7% towards the final 5 years. Looking at the EV/EBITDA ratio, like I mentioned, it's relatively high actually, I think, for a postal company overall, but that's because like Deutsche Post is one of the big ones and it's a stable one, and the stability of course comes with a premium if you kind of know what to expect, and the risk of bankruptcy is as low as it is with this postal company, because there's plenty of postal companies, right, that have a lot more risk of going bankrupt. Deutsche Post is not one of them, and that comes with the premium as well. On average, they've been trading at 12 times. I'm going to be conservative and say 10 times, because I think I've been lenient with this first year of earnings growth, so I'm going to be a bit more strict with the market multiple here. I'm going to give them 10 times. So that gives me an enterprise value. Oh, hello. An enterprise value of 155 billion, less the debt, add the cash, gives me a market cap of 146 billion divided by the amount of shares outstanding, gives me a stock price of 119 euros out in 10 years. Now, similarly for the free cash flow model, what I'm going to do is I'm going to say that our free cash flow is going to be decreasing in the coming year, 2022. They cannot reach and maintain the high peak of the COVID pandemic here. They're going to come down a little bit, but afterwards, even though historically they've been growing at 11%, I'm going to give them 7% for the 4 years afterwards and 5% for the final 5 years of our projection. Because again, I want to be conservative, and if my conservative estimate beats the stock market, I'm going to be very, very interested in this stock. I'm going to give them a free cash flow yield of 4.5%. Now, they have been going at 5.9% for the last 2 years, at which point they've been valued really quite high, but historically they've been at 3.5. Now, I'm actually not sure that they'll be going back to like the 2.1% or like even the 1.2. I think this was crazy. What happened there? Oh, the free cash flow was very low. Right. I don't think they'll be going down to those numbers. If they do, though, and they do stay at 3.5%, just to give you an indication, they will see an appreciation of about 30 euros in their stock price. But again, I want to be conservative. I'm going to give them 4.5%, which gives me a stock price indication 10 years out of 106 euros and 31 cents. So when I look at the stock market right now on this day, which is the 16th of January, what I can see is that the stocks go for 39 euros and 16 cents at the end of this trading day. So if we use the enterprise value model, I get a price indication of 119 euros 10 years from now, and with the free cash flow model, I get 106 euros 10 years from now. I'm going to cut them down the middle. I'm not sure which one is right. They're actually relatively close to each other, so I think 112 is a fairly accurate projection into the future. And with 112 as the end target for our price, we actually get a 11.1 compounding annual growth rate for Deutsche Post 10 years from now. Like I always say, on average, the stock market returns about 10% a year. So I think Deutsche Post would actually perform in line with the overall market returns, which is not too surprising because they've been growing relatively stable. They have no risk of bankruptcy. Historically, they've been outperforming the stock market, and there's still a growth story to be had when it comes to their parcel delivery business. So, yeah, I think if they keep on growing and people are going to be using parcels the way they have been during the COVID pandemic, and you actually believe that to stick, and we go more towards e-business as opposed to physical stores, I think Deutsche Post is actually a very good company and very good stock to invest in. And this 11.1% is a very conservative estimate, and if actually the highs of the COVID pandemic will maintain and also maybe expand from there, I definitely see you having some good returns with this stock. So yeah, that was Deutsche Post. Thank you very much for watching. Don't forget to like, subscribe, and all that good stuff. And I'll see you in the next one. Cheerio.